So yeah, how's everyone doing?
Very, very good.
Thank
Very,
you.
very good.
Let's see. I already see some more people coming in, so that's great. Well, hello, Alex. Hope all is well. Hello, Mr. Anabolic. How are we doing? Didn't know there were 8 of me. Yeah, stream will be recorded. Yes, yes, for sure. Good morning, Trader Kira. Yeah, so today's topic is gonna be a very, very, how can I say, uh, actual topic, as in it's about FOMC, and as we all know, today is the day of the FOMC meeting. In about 2 hours, they start. So we're gonna talk a little bit about FOMC and what we can expect not only today but also the entire year, and some interesting developments surrounding the FOMC and everything around interest rates and that kind of fun stuff. Good morning, Nine. How are we doing?
Morning.
Yeah, just know indeed when you provide notes, clear detailed notes, you will get some XP points, and definitely check out the XP rewards for sure because they're worth it. All right, I think we can another live stream packed with sauce. I hope so. I hoped I didn't forget to
How many
bring the
people were
sauce.
here on the first stream? Just drop a one if you were here on the one of the first earlier streams. And I think you've done now 3 streams, I
I
believe.
think this is the fourth or
So
fifth one
yeah, fourth and the
already.
fifth one. Yep.
Yeah.
Last stream you were on here, you pretty much called the quarterly shifts.
Oh yeah,
If
that was
anyone
fun.
actually
Yeah,
did that.
that's actually a fun fact. In the previous stream I was here, around the end I actually said like this is like your quote unquote signal to go long on the GBP, and basically it was the low of the entire run up, so that was fun. Yeah, we ripped
Yeah,
up from there, so that was crazy.
that was very nice. All right. Well, we got about 50 people in here. We will get
Yeah,
started. The
for
stream will
sure.
be recorded for anybody to come and rewatch. For anybody that couldn't be here today on May 7th, Wednesday at 11 o'clock. And it will be a wonderful time to rewatch this. It's going to be value packed. A lot of time went into this presentation as well. And we appreciate everybody for being here. Please take notes. If you have any questions, please hold them till the end, and or if they're immediately answered and I can help them out, I'd be happy to do so. Just please use your own judgment with your questions. So we appreciate everyone. Look forward to everyone being interactive. And without further ado, sign time, take it away.
Perfect. So before we start the actual stream, I do want to highlight one little thing before we start. And that's a 2 degrees library. We rolled out the 2 degrees library not too long ago, and the 2 degrees library on WOP is going to be value packed with lots of stuff, right? We've been, and with we have mean the whole 2 degrees team has been working pretty hard behind the scenes, on all sorts of educational stuff coming your way. So I just want to tell you guys, make sure to check that out when you have the one of the tools, or if you have the elite collection or the premium or any pro plus tool, you will get the case studies and PDFs that fit with the tool. So not only are we now giving you guys a tool, but also case studies on how to use them, different scenarios on when to apply them, and the full PDF guide on how the indicator works as well. And of course, with that, also in the 2 degrees library, we are releasing the end of month recaps. These are going to be value packed documents, and the first one already released. So if you have the lead collection and you haven't read it yet, be sure to check it out. We already called the whole down move on the DXY, and the right move on NQ on that as well. So yeah, value packed as I said, and next one is coming very soon. So be sure to keep an eye on that. So today's FOMC day, right? And with that comes that we can have a tool which is called the Fed Watch, and the Fed Watch basically is a tool in which traders can anticipate, or give an opinion on how they anticipate future rate cuts, right? Because is everyone familiar with what the FOMC meeting is today? Why it's there, what they're gonna do, what they're gonna tell, what they're gonna speak about? Drop a one in the chat if you don't know. How we do it? No clue about fundamentals. Plain and simple. Okay, so basically, to keep it simple, because we don't want to make this too complicated, the FOMC basically waiting for Alex to teach me. Yeah, exactly. So basically, the Federal Reserve Committee, they meet 8 times a year to make decisions on interest rates, right? And interest rates are pretty important for us as traders, to understand where the overall higher time frame direction is going to be mainly going, right? The interest rate climate is a very important part of trading, in my opinion. And with this FOMC meeting, they're going to release the federal funds rate, which is the basically the central bank interest rate for the U.S. government, right? And then they will also talk about their quantitative easing and tightening, but we're going to talk about that later. We're not make it too complicated for now, right? So basically, they're just going to release interest rate, and basically in the market, traders are pricing in a future rate cut or not rate cut, right? Or no rate cut. And what pricing in means is that, let's say every trader expects a rate cut to come in, right? Which would be bullish for the indices and bearish for the DXY. We'll see the market go lower on the DXY and higher on NQ before the actual release of the rate cut, right? Because they are pricing it in. Now, as of now, what I said with the Fed Watch, we can expect, or we can see the expectations of the market on a possible rate cut or not. And in this case, 96.8% of the market expects the Federal Reserve to not do a rate cut today, right? To hold the rates as they are. What would that mean? Well, most likely we'll just continue in the same way because this has been priced in for a long time now. Everyone expected it already for quite some while, right? Now, and there's only a 3.2% chance that they will do a rate cut, right? So what, as I said, what would happen if they do a rate cut? What would happen is most likely NQ would go up, right? So what if, right? What if they do a surprise rate cut? Most likely we'll see NQ blast up, right? Because it's just a very bullish sign for indices if the rates go down. Does everyone understand why it's bullish for indices in particular if interest rates go down? Yes. Drop a one in the chat if you don't know why. Zero? What does a zero mean? Okay, so I see a few people. They oh, you think you know why? Okay, then the zero is valid. So, long story short, right? Um, when interest rates go down, right, it's less attractive for investors to put their money into um, the dollar, right, into the US government bonds because they offer a lower return on interest, right? So, and if we are in a risk on scenario where investors like to take risk, they will seek a higher return on interest, right? And at that point, the higher return on interest is not to be found in the US dollar bonds, right? Because the interest rate is lower. So they will move all their money to a higher return on interest market, which would be the stock market, right? So therefore, more money flows into the stock market, and therefore NQ will start to go up, or ES, or Dow Jones, or any one of them. Basically, because more liquidity is coming into the market, more interest is coming into the market, right? Because they're no longer interested in a market that offers them a low return on interest, which would be the bond market. Does that make sense? Does it matter for borrowing for companies? Yes, it does matter because if the interest rate is lower, borrowing becomes cheaper, right? And if borrowing becomes cheaper, it means companies can take on more loans, which they can use to fuel their company, right? Which would only make them perform better, which would in turn lead to a stock market performing better, right? So that's why they also use the interest rates as a form of um, gas pedal and brake at the same time, right? To either speed up or slow down the economy. Whenever an economy is performing badly, they will lower the interest rate so it's less attractive to save, so people will spend more money, right? And if people spend more money, the economic machine will run faster, so to say, and it will have a positive impact on the economy. But when an economy runs too fast and it starts to overheat, right, which is also not a good thing, they will raise interest rates so it will be more attractive to save and people will start to spend less, right? So the economy doesn't grow too fast. What do I think will happen? Most likely the rates will remain the same, right? If we looked at the previous slide on the FOMC meeting May Fed Watch tool, there's a 96.8% chance that they keep the rates at 4.25 to 450. There's only a 3% chance that they will decrease the rates. I know that President Trump is a big fan of decreasing the rates, but he cannot control the Federal Reserve, right? They're a different entity, so to say. Um, so far, it looks like they're gonna keep the rates the same. That's why I put it like this: what if, right? What if they do a surprise rate cut? Um, then we'll most likely see some upside on indices, unless it's already priced in. Could be the case because we've seen a pretty big, um, bounce back since we rated those lows down here from August. So then we have another point that we can look at, right? As I said, the yields, right, for those bonds, right? We can use the 2-year yields as a sort of barometer for the short-term interest rates. Because the dollar index and the bond yields, they have a positive correlation, right? So it means whenever the yields go down, the dollar goes down. Whenever the yields go up, the dollar goes up as well, right? But there's different type of yields. There's like 3 months, 6 months, 12 months, so 1 year, 2 year, 3 year, 5 year, 10 year, 15 and 30 years, right? So there's different ones, and we can use different ones to measure different things, right? But the 2 year specifically is used to anticipate short-term interest rates, right? So if the US 2 year yield would decline, it would imply that there's a bigger chance of a rate cut coming in, right? Because the yield is basically the federal funds rates in the market, right? If the yields go up, it means most likely there's a rate hike coming in, right? Because the yield goes up. So as we can see right here, it's going sideways, right? And it's measured on the closing price, not on the low or high. It's the closing prices every day. But we can see we close basically sideways for like a long time, right? So what does that mean? The market expects no rate cut, right? And no rate hike for sure, right? heard he's going to lose his job if he did not decrease it. Yeah, there's a lot of speculation about what will happen, and yeah, we don't know. We'll see. We'll have to see. Does it make sense to everybody, or is there anything a little bit unclear? Let me know. Yeah, perfect. Right. So, can we know we can forecast or look at the interest rate for the upcoming meeting, right? But can we also do that for because there's, as I said, there are 8 meetings in a year. What's up with the other seven, right, or other six? Um, right. We can also look at the expectation for those, right? Um, it's just a bit hard to digest, but kind of makes sense, right? Is there anything that doesn't make sense or that would help clear it up? Or what's the part that's hard to digest? Let me put it like that. It's new stuff. Yeah, yeah. If it's new, it can be a bit tricky to understand at first. But don't worry, that kind of stuff. Once you look at it for a while, it will become easier. Yeah, yeah. He could remove Jerome Powell. That's the only way he could influence. Uh, yeah, the interest rate, but he cannot do it directly. Yields are related to a rate cut. Yes. So as I said, the U.S. 2-year yield is basically the yield in the market, right? And whenever yields are going lower, or whenever they increase interest rates, right, yields will go up, right? Or vice versa, when they decrease rates, the yields will go down, right? If they keep the rates the same, the yield will stay the same, right? More or less. Now we can see that the US 2-year yield has basically been trading sideways while the DXY is going lower, right? So what does it mean? The dollar is becoming cheaper while there's no real expectation of a rate cut just yet, right? So that's how you can compare the 2-year yield and the dollar index to kind of have an idea of what you can expect in terms of short-term interest rate expectations, right? Why 2-year yield? Because it's short-term, right? There's different type of yields. We can have a 2-year yield, or 5-year, or 10-year, or 30 years, right? Why is a 2-year yield specifically for short-term interest rates? It's because it's a bond, right, with a short-term maturity, so to say, right? It only lasts 2 years. If you invest in a bond that has a 30-year yield, right, or a 30-year maturity, if you buy it now and you would hold it for 30 years, you would kind of expect um, decent returns, right? Because you're holding it for a very long time. You're basically taking on more risk in the form of time, right? That being said, it's less affected by short term fluctuations because you're looking at a broader horizon, right? But when you're looking at a 2-year yield, it's much more affected to short term changes purely because the maturity is much shorter, right? So, for example, the 30 year, right? If you overlay the 30 year with the DXY, usually the 30 year will um, act as like the broader, um, as like a big boat that is the overarching, how can I say, direction for the DXY, right? Because that's the big broader bond yield that's for the long term, right? So it also usually what we'll see is that the DXY will follow the 30-year bond yield eventually, right? So if the DXY, let's say like this, we expand lower pretty quickly, but the 30-year bond doesn't start to go lower and it goes sideways, we'll usually see the DXY do sort of a mean reversion and go back up towards the level where the 30-year yield is at. But with the 2 year, it's not the same because it's a very short-term expectation. Right. So as I said, we can also do the forecast for the next meeting in June, right? And in June, the numbers are looking a bit different, right? Already 68% is expecting no rate cut. And now we have an increase to 30% of the traders that are expecting a rate cut of 25 base points, right? And 0.6% is expecting a 50 base point rate cut, right? So the chances are that in June we have a little bit of a bigger chance to see a rate cut. And the closer we get to the date of the FOMC, the more this will change, right? Because let's say between now and June, a lot of stuff happens in the economy, and it makes more sense to do a rate cut. This number will go up, and this one will go down, right? Um, by the way, just in between, if you read the end of month market recap, we also talk about this a little bit more in depth with an analysis about it as well. You're more of a technical trader. It's not new to me, but you never took the time to understand it. Well, depends, honestly. I'd say it depends if you need it. If you trade the 15 seconds chart, every other day, it's not too important because you're trading short-term intraday volatility, right? But if you look at the daily chart in any form or way, that one was personal. If you look at a daily chart or a higher time frame chart, you definitely need to, or definitely need. I'd say it's definitely beneficial to look at this kind of stuff. When issues rise between Powell not cutting the rates and the orange man, how will this impact the DXY and investors? That's a good question. A good question. It depends, honestly. Because if there's tension, right, what would that mean? It means there's uncertainty inside the US government, right, which could um, it could go two ways, right? Either because there's uncertainty, people they feel unsafe inside the stock market, right? And they would exit the stock market to go into a safer market, which would be the US bonds again, right? Then we'd see the indices go lower and we'd see the DXY go higher, right? On a second note, it could also be that there's political uncertainty. And if people are not only afraid of their money inside the stock market, but they're afraid to be inside anything American for that matter, because there's such uncertainty in their government, it could also be that they will seek safe havens in the form of other countries, right? So they would even exit the US bonds and they would buy maybe Japanese bonds, for example. Um, did the audio cut out for everyone, or is it just all good? Okay. The first part about yeah, CHF might be more safe. For example, the investors could seek more safety and they'd go to the Japanese yen or they'd go to the Swiss franc, right? And then we'd see both the DXY and the indices go down, right? And that's when markets kind of get decoupled because classically we're told that the DXY and the indices they are inversely correlated, right? But it doesn't always have to be that way. Because let's say the US economy is doing like very great, right? It could be that the DXY and the stock markets both go up at the same time. So it's definitely not a one-on-one correlation at all times. Right. Then we're going to look at the FOMC meeting in December. And then you can see that the numbers have changed pretty dramatically, right? Where we had the 425 to 450, that's where we're at now, right? And only 0.3% of traders expect the market or the Fed to hold the rates until December, right? Which is logical. Um, because the US economy or the US Fed is in a cutting cycle and they're not in a rate hike cycle. So the likelihood of them cutting rates anywhere this year is pretty likely, right? Um, most people expect the Fed to cut basis or the federal funds rate to 3.5 to 3.75%. Right, that's the general consensus in 36.4%. So that means we got a couple rate hikes coming up most likely, right? That's what the market's expecting right now. So what happens if rates are being cut? We told about it. We talked about it earlier, right? If rates are being cut, what happens to an economy? Let's see who listened. What happens if the Federal Reserve cuts rates? What do they want to do to the economy? Yeah, more spending, growth, stimulated, perfect. Cheaper dollar, yeah, the dollar gets cheaper. That's true. Basically, they want to stimulate the economy, indeed. And if the economy is stimulated, it means most likely we're in a risk-on situation, indeed. Right? What happens to the stock market then? Most likely, the stock market will go where? Will go up. Perfect. Right. And if you would combine this information, right, with the seasonality, for example, right? What do you think would happen? Would be a pretty big confluence on each other, right? Look at when the FOMC dates are and look at when the expansions are on the seasonality. Might be something interesting to look at. 100% accuracy, that's no, don't want to guarantee 100%, but yeah, potentially very solid confluence on what you can expect happening, right? Yeah, we did back in January. Right. So the FOMC meetings, right? I'm not sure if you all can remember, but close to the end of last year and like the last quarter of 2024, the big thing in the markets was inflation, right? Inflation was so important. You heard the term every other day. People were talking about inflation constantly. Inflation numbers, so the CPI stuff, was incredibly volatile, right? And nowadays, sometimes we see a CPI and it's barely the same amount of candles that a normal AM session would run, right? Where usually a CPI candle could like dictate the overall higher time frame direction because of the crazy expansion it would give, right? Uh, Why is that? Does anyone know? Why is it that now all of a sudden inflation seems not important anymore? Even though a few months ago, um, inflation data was the most important stuff there was. Yeah, 100% accuracy is wild. That's that's a bit too much, I'd say. Different administration. Well, yeah, but at the same time, the Federal Reserve hasn't changed, right? And they dictate the direction for the interest rates, not the US government. We had a stable market back then. Yeah, that's true. Inflation is stable. That's also true. We've stabilized inflation. And it's also a big part of market narrative, right? At the end of last year, it was inflation, but now we hear almost nothing about inflation anymore. And it's all about tariffs, right? Every once in a while, or not every once in a while, every few months, the overarching narrative of the market changes, right? And that's going to be the most important part of the market at that time, right? Um, Back when it was inflation, whenever NFP came out, which was which is labor data, um, labor data would get overridden by inflation news, right? And let's say we've had NFP on one day, and then the next week there's just news about inflation, not even the actual CPI numbers, but just news surrounding inflation, it would completely override any effect NFP would have, right? Then it changed to the labor that the FOMC statement that you can read. The Fed was saying they were monitoring the labor market really closely, right? And if there were any changes in the labor market, they would act upon it in the form of cutting rates, right? So make sure that the economy doesn't slow down too much. So then, anytime any labor data came out or labor related information came out, it was suddenly much more important than inflation, right? And now we're in the era where tariffs is the overarching market narrative. And what happens is that overall, anytime Trump says something, and I'm sure we've all noticed it like the couple last months, anytime the guy says something, NQ will go up and down, left, right, and in circles, right? Because of what he's saying. And anytime we have NFP or we have CPI or whatever it is, it almost seems as if it's not important anymore, right? Even though they are important, right, for the US economy to see what's happening. Um, so that's how kind of market narrative changes the entire landscape of how the market will move, right? Because usually we'll say NFP often is seen as the Judas of the month, for example, right? Um, in today's age, doesn't count, right? Because NFP could go down, we could go up after, and thinking, okay, we have NFP rate the lows. It could be, could be the Judas. And then the next week, Trump comes along and says, no, we're not going to do any deals. We're going to enforce more tariffs. We're going to do more stuff. And then NQ tanks down and still takes out NFP lows again, right? So that's what I mean with it will override any data point there is. Base Capital Investment says, from my understanding, tariffs are paid for by the consumer. How does this play into the strength or weakness of the US dollar and the direction of indices? Well, that's true, but at this point, it's also about the stability in the market, right? We've seen basically a trade war unfold now, right? And that invites a lot of uncertainty, right? So the way you can kind of view it now is that when there's more uncertainty, NQ will go down. That's what we have seen in the last big sell-off, right? That happened right around the whole tariff situation and the trade war, right? NQ went down quickly because of the uncertainty in the market, right? And then afterwards, more and more countries started to make deals with Trump, and they started to, lower the whole tariffs and make up, and be friends again, and we see NQ kind of recover again, right? But right now, going up doesn't necessarily mean that we're straight bullish, right? For me, if we go up now, it just means there's more stability, right? Because there's a very big overarching story in the market, right? If we go further down, it's obviously bearish because it's usually induced by fear and whatnot. If we continue to slowly go up, it's more likely that we have gained more stability, right? Because usually a stock market goes up anyway. Yeah. So overall, like the tariffs, they how does it play into the strength or weakness of the dollar, right? So um, in the short term, it can bring more dollar strength due to inflationary pressure, right? That what we're seeing now. That's why they are not cutting rates as fast, right? Because they want to monitor the inflationary pressure and the whole contracting U.S. Uh, economy. That's the reason why they would want to cut rates. But um, if inflation starts to rise from now on, right, because of tariffs, they might stop the rate cutting cycle, or not, or pause it. Let's say pause it, not stop it. They will pause it, right? They won't cut rates as quickly because there's no need for it then. Um, but in the longer term, it could mean a weaker US dollar because of a growing trade deficit, right? Um, Higher tariffs, they can reduce the import demand, right? And are you all familiar with what the GDP is of a country? That's an important part of this. Drop a one in the chat if you know what the GDP is and what it's used for. Gross something. Yeah, yeah. It's a gross domestic product. Perfect. Yeah. Basically, what it is, it's one second. It's the a number that we can use to identify how big an economy is. It's the wealth a country builds in a year. Well, not particularly, right? Yeah, it's a more a measure of economic output indeed, and basically it measures the total monetary value of all goods and services within a country's borders, in a specific time period. Um, right? And it's actually the GDP is a formula, right? It's the output of a formula, and the formula basically is um, consumption. We add the consumption, which is spending by households, right, on goods and services, for example. That's what you mean, but you don't have the vocabulary. Okay, then you get points for that. Um, the investment spending on capital goods by businesses or households. We add the government spending, right, on goods and services, right? We add that up, and then we have a separate one between brackets where we um, have the exports minus the imports, right? And that's what we call the trade deficit. And we add that to the prior three categories, right? And that as a total will determine the um, basically the economic performance in a way. So as I said, with the whole trade deficit stuff, if the U.S. starts to um, export less and less and less, right? If they start to import more, right? Because then it will potentially narrow the trade deficit. However, if other countries start to retaliate with their own tariffs, as we're seeing now, right, the U.S. exports may decline, right, negatively affecting the trade balance, which could weaken the U.S. dollar. Basically, this stuff is all a big chain reaction. If one thing happens, numbers change, and big chain reaction gets set off. And additionally, if there's longer trade tensions, it can hinder economic growth, leading to lower interest rates and a weaker dollar. So overall, this whole tariff and trade war stuff is never good for us traders. Because what could happen sometimes is like what happened to the euro and the dollar in 2018 out of my head is that we basically went sideways for an entire year. So let me see. So with the tariffs, the US is getting less imports. However, we are not getting a lot of the products we normally do. So does that mean these products will be in high demand in the US and other countries we import? Yeah, so basically there will be in high demand, but other countries might also retaliate, right? And therefore put up counter tariffs. That's what we've been seeing, and therefore it might get more expensive and the trade deficit it doesn't it's not worth it to import, and the trade deficit widens, right? So that's why market narrative is the most important thing in the market at this point, right? So there's, as I said, there's one way how the Federal Reserve can influence the economy, right? First thing is with interest rates, right, which work as a gas pedal or a brake, right? Cutting rates is a gas pedal, hiking rates, so upping the rates is a brake, right? There's another thing they can do to kind of influence the economy or stimulate it, right? Or slow it down. There's two ways they can do it, right? So one is the interest rates. Does anyone know what the second one is that they can do? Because they cannot change policy, they cannot change laws, they cannot change taxes, they cannot do anything in that matter to kind of stimulate the economy, right? That's the job of the government. Does anyone know what the other option is the Federal Reserve has? Yeah, a terrorism attack. No, I don't think it works like that. Yeah, QE, that's the right one. QE and QT. So we're going to look at that now. Quantitative easing, indeed. Does anybody know what quantitative, or does anyone not know what it is? Quantitative easing and tightening. Thank you, Josh. Thank you. Appreciate it. Yeah, I thought it was a nice topic to go about, today with FOMC being today. It'd be good to gain some more info before FOMC happens. Since we're going to be fun, because now we have the expectation lined up, right? And then after FOMC, which is going to be way after the stream, um, I will make a post inside Escape, reflecting on it. We can look at the FOMC statement and see how this stuff that I just showed you, because these pictures have been taken yesterday evening, right? We can see how this changes then, right? And I will make a comparison with it. So back to QE and QT. Does anyone not know what it is? Drop a one in the chat if you don't know. I see some ones, and I see also someone that some people that do know. So yeah, basically, quantitative easing, they are basically opposite actions. Right? Print more money. Yeah, it comes down to that, so in some form. Basically, quantitative easing refers to the Federal Reserve buying assets, right, to lower the long-term interest rate, and quantitative tightening means the Fed is selling assets to put upwards pressure on longer-term rates. So, when they want to stimulate the economy and reduce interest rates on longer-term interest securities, the Fed does this by purchasing large quantities of treasury securities, so that's treasury bonds, T bonds in the States, or mortgage backed securities, right? It can lead to that, yeah, can. What we see here on this chart right here is the Federal Reserve balance sheet, right? So it's the balance sheet of the Federal Reserve. And what we can see here right around COVID, they started a pretty big quantitative easing cycle, right? So they started to buy up more and more and more to kind of put uh, oil in the fire for the economy and make sure the economy gets um, a little bit of a push, right? And can anyone tell me what the market narrative was back then? I think you're all pretty familiar with the market narrative back then. It's all we could speak about in the news and stuff in 2020. Yeah, inflation, but a much bigger thing, Josh. Much bigger than inflation at that point. Because yeah, COVID, exactly, COVID. COVID was the market narrative back then. Not sure if you were on the markets back then, but COVID was the main big thing back then, right? We had the stimulus checks, we had yeah, COVID up only, exactly. Since like at COVID we crashed, and then afterwards they started up quantitative easing, they gave up stimulus checks, you know, they started pumping money into the economy, and I would say there was never a crash, or it was just a crash, and we kind of recovered from there because we've never seen COVID lows again since then. And then back in 2023 or 2020, halfway 2022, the inflation started to go crazy. Right, we had 15% inflation in the States, which is pretty big, pretty high. We had the same amount, I think, here in Europe as well. I can remember stuff was expensive as shit, still is. That's where you can see they start to the quantitative tightening first, right? They started to let loose of the assets, sell them, right? Put upwards pressure on the long term rates, make sure people start to save more, right? So the inflation can be tamed a little bit. And then afterwards, they started to cut the cycle or cut the rates as well. And now we're in the rate cut cycle. So would it make sense for them to suddenly do a rate hike? No, right? Because that stuff only happens in cycles. First, they start a rate hike cycle, like we had before. We were at 0% interest rate. The QT was supposed to stop at the end of the first quarter, so that's why this chart appears to be flattening out. Yeah, well, that's a big thing, right? Because if we expect now that we are getting into a rate cut cycle, right? And we expect them to kind of want to stimulate the economy, and maybe we want to see if the um, stock market can go up, right? That stuff goes hand in hand because they have two tools. So if they're not um, gonna cut the rates now, maybe they will tell us something about their quantitative tightening, right? Maybe they won't necessarily start easing right away, but they can slow down the tightening, right? And that's something that we'll see. Indeed, we will see it flattening out, right? And then once they, a new economic cycle comes up and they will restart the easing, we will see the balance sheet go up again, and that will probably will go paired with another massive bull run. Yo, Colin, man, how are you? Good to see you. How do you think the price action will be if the rates are kept steady today? Most likely the same because everyone already expects it to be the same, right? So there's no reason to freak out. There's no reason to. Yeah, it's always volatile during the speech, right? But it could also settle down afterwards because during the speeches it's always volatile, right? We usually expect a two-sided move or two-way move, whatever it is. Um, but in the long term, most likely NQ will just go steady as she goes. Will go the same way. Yeah, I'm doing fine, Colin. Thank you, thank you. Yeah, yeah, that's true. That's true. I entered 0.01 seconds after Colin in a trade, same exact trade, and closed it. Yeah, crazy. Yeah, so it will be interesting to see what they'll do today. I don't think they will do a surprise rate cut. If they'll do, it would be fun to see what happens to the market. Would be a fun thing to analyze afterwards. Most likely we'll see NQ skyrocket up because no one expects a rate cut to happen now. And if they really want to rate cut right now, then NQ most likely will go up. Um, if they keep it like this, NQ could still go up. It could still go down. It doesn't really matter at that point. It will just follow the overall market narrative, and that's still tariff. So if Trump starts talking about stuff again, and then, you never know. Maybe they say, we're gonna rate cut now. They rate cut, and then next week Trump every day starts talking about how they're gonna shut down more deals and do more tariffs and even higher tariffs on China and more tariffs for you and for everyone. Then NQ will still go down and kind of override the whole interest rate decision. Even though interest rate cuts would be bullish, at that point there's too much uncertainty, too much fear in the market to continue going up, right? So yes, the interest rate's important, but at this point, the market narrative always kind of overshadows it. But if it goes hand in hand, and perfect. It will only add more fire to the oil to the fire, right? Basically, that's it for the presentation part of today's stream. So I wanted to end off with a little bit of a Q&A or AMA, or just ask any question you have, and we'll go over it. Or let me know if anything was unclear or you want some more information about the stuff that we talked about. Thank you. Thank you. And this was just the first stream of many, man. Or the fourth or fifth stream of many, of course. We had some before. Really like the thing about the current market narrative. Well, yeah. Yeah, it's an interesting thing for sure. And it's also very important, of course, because, let's say you would have your head in the sand, or you lived under a rock. You don't know about the whole tariff stuff, you would probably freak out when NQ jumps up 200 points within 1 minute for some reason, right? But if you understand that Trump said 7 sentences again, can replace Fed members. I don't think so, man. But thank you. Just need to learn how to apply it to trading. Yeah, for sure. You usually, you don't use it directly into your intraday trading, of course, right? Because it's most likely based on different stuff. But you can, however, use it to shape your understanding of the higher time frame, right? To really understand where we will most likely go towards, right? Combine it with your technical analysis, whether that may be ICT or even if it's support and resistance or whatever it is. Um, Hand in hand, they will work phenomenally. How will gold react to rate cuts? Well, gold is usually seen as a safe haven, right? Gold's a safe haven asset. So whenever there's war, whenever there's uncertainty, usually gold will go up. Um, so gold usually like it's a non-yielding asset, right? Which means it does not yield any interest. It doesn't yield any dividend. Um, when interest rates are cut, the opportunity cost of holding gold decreases, right? Because investors can earn less or interest on interest-bearing assets like bond. So typically, it would usually increase the demand for gold, pushing it to higher prices. Also, if you look at it from a currency side, a weaker currency would mean higher gold prices, right? Because gold is rated in a currency. So let's say 1 ounce of gold is worth $100, right? But let's say that same $100 decreases in value, it would mean therefore that the gold would be worth more in dollars, right? Because it's denominated in dollars, so the gold will go up. Yeah, usually it's used as a hedge or as a safe haven asset, so that's where it will react upon. Can I explain it all again? Yeah, let me just do it real quick. No, I've recorded for sure. Don't worry about that. I will make sure to upload it right away after the stream, so it will be in the live stream database as soon as possible.
Very, very awesome. Very, very awesome. I got a quick question for you, Time. Is there any chance you can just share one of your
Yeah, no.
layouts?
Any other
Not
questions by anyone?
necessarily like, yeah, not necessarily like just the link, but just to show like people your higher time frame picture and like basically like the layout with the seasonal tendency, the COT, the seasonal OI. I know that you have one of those layouts. You just drop a photo in there. And maybe I think you have like the interest rate as well. You guys can see that we pretty much have automated a full higher time frame photo of what is being displayed in terms of the technicals. We actually have the interest rate and GDP dashboard. We have the open interest. We have the seasonal tendency, commitment to traders, and I mean, I think that it's appropriate to say that we should probably have a Fed watch one, right?
Well, we should.
So that's interesting that how many people would want to see something like that? I know that you wouldn't like use it like every day, but I think that'd be kind of cool just to have
Yeah, how many
a
people would
brand
be
new.
interested in like something about any macro thing, macro dashboard or whatever?
There you go, athlete. Yeah, that's exactly it. That layout's very nice. Awesome, awesome. So yeah, the higher time frame photo, don't forget it. Absolutely. All right. So it looks like basically you guys can also see that the higher time frame photo does, include that seasonal tendency. And I think it'd be awesome to give away a seasonal tendency to someone that is in the crowd. Even if they have the elite collection, they can just have an extra month of this seasonal tendency. And we'll do like a little giveaway of that. If that sounds good, let us know in the chat. We'll drop that.
Yeah, clean charts are important for sure. But with the seasonality, it's not a tool you look at every day or every minute. You use it. I use it every week, for example, just to check.
So
Yeah,
I'm
or
gonna
having
give
several.
away.
Anyways,
Go ahead. Go ahead.
oh yeah, having several layouts always helps with keeping it clean for sure.
So there you guys have it in the chat. You guys want to enter. It's a 3-month access to the seasonal tendency. Anybody can enter. Um, really, again, this tool is just for a higher time frame photo, and you guys can monitor it for basically a good quarterly shift to call it. So it's only going to be around for another 30 seconds. So cool little giveaway. There you go, Cameron's. Shout out to you. Seasonal pivots are definitely chef's choice. Yeah, I'd love to see more higher time frame layouts in the chat. I know that we also have like that stocks and options channel that you guys can post higher time frame like setups on different asset classes there. And feel free to post anything else also in the respective channels. You can always post in general chat too and start a discussion. Eve, Eve, are you here?
Congratulations.
Awesome. Congratulations to you. Shout out to you. If you open up a ticket inside of Escape, we'll be able to get you your prize. Someone just asked, how do we enter? The giveaway was a 1 minute long for those that are just interactive with the chat. Um, there's 15 entries, so it's pretty good odds, honestly. So pretty cool. But yeah, it looks like we're wrapping up the rest of the questions, and everybody can more or less find assigned time also inside of our Discord. He does post. So yeah, just tag him if you have any questions. I'm sure that the recording will be up in due time, and everything else seems like we've been answering it, and many of them are just going to be awaiting the news. So please be safe, be mindful, and be responsible.
Yeah,
So
don't gamble your capital. Please don't.
awesome, awesome, awesome. All right.
Perfect.
So without further ado, again, we will catch you guys all very soon. We have a stream coming up with